Hi students, I am hoping that all of you are staying safe and well at your home, and also I assume that all of you watched that previous video lecturing which I already uploaded in the LMS. I assume. So in the previous video lecturing, I clearly explained the relationship between these assurance services, attestation services, and then finally I introduced the term audit. And also we discuss these three terms with the help of diagram. And also we discuss another important matter, that is the assurance services and non-assurance services. But you should understand when we say the assurance and non-assurance services, the particular audit firm or the audit company or the public accounting firm, they provide assurance service and also some other services. In addition to assurance service, in addition to audit, they provide some other non-assurance services like tax services or the bookkeeping services, so accounting preparation or some other consultation. So this kind of services also provided by this audit firms in practice. So that's these things connected with the first objective of our this first handout. So today video lecture, I'm going to clearly explain the other objectives, second, the third, fourth, and fifth objectives of this handout. So here you can see the handout. I'm going to show the handout. Wait a minute. And so actually, if anyone failed to watch the video, when you get the free time, so you can watch and get some idea. I don't try to stress anyone to watch the video. So when you get a free time, when you feel free, you can watch and get an idea at the same time. You can handle also. So here the PowerPoint. These are the objectives. No. Yes, the first objectives we already discussed in the previous video lecture. So today I'm going to talk about this second, third, fourth, and the fifth. And if we have the time, we will discuss about this objective also. So the second objective is say understand the origin and evolution of auditing. We'll discuss. The third one says differentiate the term auditing and accounting. It's important one. We'll discuss. Then next one says define and discuss the term auditing, and then the one say discuss the features and objectives. So one by one we will discuss. So here today video lecture I'm going to start from this handout number 14. So this is an introduction and overview of auditing. Here you get the first point you can see. The economic decisions in every society must be based upon the information available at the time the decision is made. So the previous video lecture also clearly explained a lot of things we discuss about this information quality, definition of how this information quality is. Quality information is essential to make the good decision. So this also the first point says that one, the economic decisions in every society must be based on information available at the time the decision is made. That's correct, no? Because as I told you earlier in the previous earlier video lecture, in order to make the decision, we need the information, the adequate enough information. So for example, the decision of a bank to make a loan to a business. is based upon previous financial relationship with the business, the financial condition of the company as reflected by its financial statement and other factors. So the actually that is a practical one. So the when the businessman approach the bank to borrow the loan for their business activities, definitely the bank point of view, bank definitely verifies some information. They think about a lot of information. The actually the, the, the first one says the first bank manager their previous financial relations with a particular business. So the previous the particular businessman already received borrow the loan from the particular bank. The person QC properly settled the loan without any due, any problem, any issues. So the bank manager happy because their previous financial relationship was good. So that's a good character, indicate a good characters of the business. No, that's a one factor. That may be the one factor. The second one says the financial condition of the company or the firm. That's the important one. So because when you approach the bank to get a loan, so definitely the bank try to verify your the financial worthiness, the financial condition. Financial condition means they try to check your statement of profit or loss in order to know how much profit of your business in the last financial year, or in order to know your business profitability. So that's definitely important to the bank. Generally, they can they will be happy, because generally you have the capacity to return their money in the future. So at the same time, they may check the statement of financial position of the balance sheet. Why the bank try to check the statement of financial position of balance sheet, or that show the liabilities and assets, so the bank can understand how much liability and assets are there for the particular business. So then, so this is such a way they check their financial conditions before the proceed the loan, and also they consider some other factors, environmental factors also there. So that's a this is an example. The second point say is the identity indicators. So the information used in the decision process must be reliable. Again and again, I emphasize you all as when we say the decision making need adequate or enough information. So that information should be quality in the terms of reliable and relevance. So this point also says the information used in the decision process must be reliable, must be genuine, not fake information, the reliable information. It's the unreliable information, it means a fake information, unreliable, fake information, misinformation can cause or create inefficient use of resources to the damage to the society and to the decision maker. This is obviously understand this because when you make the decision, the decision should be the information should be reliable. Otherwise, the information is unreliable or the fake or inappropriate information. What happened? Because the creator inefficient use of resources. Everything is waste because of when we make the decision. So we normally the company, this businessman point of view, the company, the firms, when they make the decision, they spend a lot of time to make that decision, come to the conclusion. So a lot of energy, a lot of people involved in the process. So because that's a so because finally they take their decision. So when they make a decision, they use the information, that information is not reliable or unreliable or fake information. What happened? Everything is a waste. Finally, they damage the society and to the decision maker, they then affect the particular company directly. Business totally damage. So then, as society become more complex, what does it mean complex? Complicated. Complicated, you understand, you are very familiar with it, very complicated. Sometimes they don't really particularly use the term. He's a very complicated person. Complicated means we couldn't properly understand the person. We can't predict the productivity. So nowadays you can see our society because of our environment. So the business, especially the business market or business environment, the very uncertainty. Uncertainty means because you can't predict anything properly because that's a dynamically change, dramatically change, because suddenly change because of this globalization. We are living 21st century, so high technical world. So the business competing with other business very hardly and deeply. So all the business try to use high tech technology. So there are a lot of advertisements are there because different types of business. No? Because so before 10 to 15 years, you can't see this kind of business types, no? Online business. So a lot of Amazon.com, Big.com. So the eBay, to know the physical place to purchase sell the goods. So the virtual environment is there. So then as society become more complex, more complicated, no? there is there is an increased likelihood, but doesn't mean likelihood. There's an increased probability of chance that unreliable information. So when the society become more complex or complicated or difficult to understand, there's a more to chance for this unreliable information will be provided to the decision makers. So at the time, decision makers they have to be very careful. The business, the environment is surrounding is market is a very complicated, very difficult to predict, very complex. So there's more chance for this kind of unreliable information, the fake information, because the high competition is going. So simply nowadays you can see the advertisements, especially the Indian the TV. You can see the especially Indian stations very attractive. Definitely that's a main tool the business use to attract the customers. Even small kids are very attracted for this advertisement. Simply when they make the advertisement for the toilet soap, a particular cosmetic item, these liquid items, the washing powder, whatever it is. So that particular advertisement I observe says if you use this particular liquid washing powder or whatever it is, so it will remove the 100 types of infections or whatever it is. So do you think that it is possible? No. So if you take this medicine, so you can get a solution for the 100 types of the problem, sickness. So this is possible. Everybody know this is impossible with the solution for 100 variety of 100 types of sickness, no? 100 problems. But even they advertise such a way. So that's the kind of environment we are living. So as a society become more complex, there's an increased likelihood that unreliable information will be provided to decision makers. The next point says to overcome the problem of unreliable information. So in order to avoid this problem of unreliable information, the decision maker must develop a method of assuring him or her that the information is sufficiently reliable for this decision. So then the problem is, so this kind of situation is there. So in order to avoid this problem of unreliable information, fake information, particular decision maker, you may be the decision maker. Myself, I'll try to make some decisions. So we have to develop a method of assuring him or her that the information is sufficient. So in order to get a reliable information, the adequate and reliable information, we have to develop or we have to create a method of assuring, verifying, and so the audit is there. So then to a certain extent we can expect to receive the reliable information from the company financial statement because the external person is going to verify or examine the financial statement of the company. After verify uh, the information, so independent person give the opinion. Is everything is okay or not? So here, this point clearly says to overcome the problem of unreliable information, fake information, then we can go for audit. So here, last point says a common way to obtain such reliable information is to have some type of verification. So there is verification. If there is any type of verification, it means audit. So definitely we can sure to get the reliable information, the truly information, the true and fair information. So the genuine information, the proper information, not improper information. So that we can get a genuine information, it means reliable information performed by different persons. So I hope you understand. These two slides introduce with some overview of auditing. So when you read these two slides, definitely understand the importance of auditing, why it's the purpose of auditing. So you know worry, no need to worry about these two slides because the examiners and question from these two slides. But in order to answer other questions clearly, you should have to clearly understand these slides. Don't try to memorize. Just clearly understand it. Just don't stress yourself, no? Because of the memorize, because that's not nice. So never examine asks any question from this two slides. Just there's an overview, say overview, but some most practical and important points are there. Just read and get understand. So then we can say the origin of auditing. Origin means that we are going to discuss when the auditor evolved, what's the status, constitutes of auditing. So different things we are going to discuss here. The word audit is derived from the Latin word audio, which means to hear. The word audit is derived from the Latin word. Number of the Latin word is to be used. Audit also the Latin word audio, then that's indicate the meaning of to hear. To hear me? To listen. To listen. The second point says in early days, those days, an auditor used to listen to the accounts read over by an accountant in order to check them. So in the important one, those days an auditor used to listen to the accounts read over by an accountant in order to check them. So those days, what was the role of auditor? The accountant, the reader figures, first auditor listen to the accountant. So what we see read. That was the role. The first days, the auditor role was there. Yeah. The original objective of auditing was to detect and prevent errors and fraud. This is important. That's what I highlighted. So that's this is a when we read the history of auditing. So the history clearly says that those days the auditor used to listen to the accounts read over by an accountant, account read the figures, then the person auditor listen to the accounts what we read. So that's what we say that that's what we can say. The earlier objective of audit was to detect, not delete, not direct, to detect me. What's mean of detect? To find out and prevent me the prohibit, stopping the errors or stop or prohibit errors and fraud. We will discuss clearly the coming slides or similar errors and fraud. So this was early objectives. Please remember. So the third point says auditing evolved and grew rapidly after the Industrial Revolution in the 18th century with the growth of the public companies. The ownership and management became separate. This point is very, very important as a management student. Definitely, you should understand the story behind this third point. Actually, third point says the auditing evolved and grew rapidly after the Industrial Revolution. I know, I hope all of you have some idea about the Industrial Revolution. You already know, at least you heard about the term Industrial Revolution when the 18th century. After the Industrial Revolution, that's a turning point of auditing. No? That's a turning point of auditing because after the Industrial Revolution, the audit grew rapidly from very quickly emerged, developed because after the Industrial Revolution, with the growth of the public company, because after the Industrial Revolution, what happened? The big change in the organization setup, that is the public companies quickly, gradually emerged, established, developed. The public companies. I know the last video lecture also I just we discussed something about the organization setup. There we discussed the private and public companies. Here, actually, the most important one is the public companies because after the industrial revolution, the public companies growth very quickly. So the company ownership and management becomes separate. The story behind the public company, you know, the public companies, we can say the PLC, no? Public companies. When we say the public companies in Sri Lanka, approximately, as I told you earlier in the previous video, 300 public companies are there. All are listed at Colombo Stock Exchange. Colombo Stock Exchange, all are the public companies. The banks, number of banks are there, hotels are there, restaurant companies are there, real estate companies are there, trading companies. So many different types of companies are there, all are the public companies. So the thing we can ask a question, what's the problem behind this public company? So this public company is very, very well connected with the audit. Actually, the public companies, you know, I hope you studied in the O level or A level even in the first year in the university. The public companies, what's the difference between the public and private companies? So simply you can say the public companies, they can, in order to accumulate capital, they can issue the equity shares or honorary shares to the general public, isn't it? Yes. But private companies, they can't issue the shares to the third party or general public. It's just different between these public and private companies. So when the public companies, when they sell the equity shares to the general public to collect the money or to accumulate the capital, so what happened? So the number of people purchase the whatever shares from the public companies. For example, if you take the Kagas PLC, in order to collect the Kagas PLC a certain amount of capital, they normally issue the whatever shares to the general public. You know, the already has some idea about the shares. It may be the 10 rupees. So 10 rupees. So the anyone can purchase the shares from the Kagas PLC. At least, at least the person can purchase one share from the particular company. The maximum also there. When some person purchase of 50,000 or 500,000 or 50 million, whatever it is, it's not a matter. Number is not a matter. But when the person purchase one share, one equity share, or share from the particular public company, that the particular person is called as shareholder of the public company. The shareholder of the public company. The example, if you purchase the one ordinary share from the Carlos PLC, then you can say you are one of the shareholders of the Carlos PLC. If I purchase 10 shares from the Carlos PLC, I can say I'm one of the shareholders of the Carlos PLC. So the Carlos PLC, then who are the owners of the particular Carlos PLC? Because the original shareholders are the owners. Yes, but the other setup, we can see in your area, in your environment, number of grocery shops are there. So the beauty bar are there, grocery shops are there. So then the number of cafe are there. So then Mm, photocopy shops are there, textiles are there, jewelry shops are there, other businesses are there. Most of the business are the sole traders or sole proprietors. Probably have some idea about the sole traders. You can see the sole traders, and the one person is there, the person is owner, and the person actually actively involved in the business activity. That's a different setup. The one person is there, person invest the money, the person direct the business, all the profit are taken by the person. The suppose loss happen, the person have to suffer all loss. That's the story behind the sole traders or sole proprietors. But when you see the companies, especially the public companies, the story is totally different because the the owners of the public companies, in our example, the Kagas PLC, owners are the shareholders. Yes. This point says the auditing evolved and grew rapidly after the Industrial Revolution in 18th century. With the growth of public companies, okay, the ownership and management became separate. You should understand clearly. Ownership. What's the meaning of ownership? And the management. The thing is, actually, after these people purchased the ordinary shares from the Target PLC, these people are called as the all shareholders are called as the owners of the company. So then you can assume when the Target PLC issues the shares, actually Target PLC issues 10,000 ordinary shares. So the minimum 10,000 people, um, so maximum, you can assume the maximum 10,000 people can purchase the shares, one share to the one person. So 10,000 shareholders are there, target space. So 10,000 owners are there. You can imagine the story, no? So when the target space is ordered shares 10,000, every people purchase, you can assume one share per person. So the maximum 10,000 shares. So the 10,000 shareholders. It means the 10,000 owners. So then the sole trader, the sole proprietorship is owner, invest the money, the person direct the business, yeah, actively involved in the business activities. In this case, this scenario you can apply in the public companies or not. No, you can't apply because this is only one person. Owner, invest the money, actively involved in the business operations and activities, then enjoy all the profit was happen. So then the person had to bear all the loss. But public companies, the shareholders, owners, they have to, they are living outside the company. So then you can ask a question. Then who will direct the company? You know, the commercial bank is one of the public companies, international bank, the famous hotel, John Case, Taj Hotel, Samtra Hotel, Jetwing. So then who will direct the company? So because the ordinary shareholders are the owners, all the 10,000 people or 50,000 or 100,000 or whatever it is, they are sitting outside the company, outside the board. So the story is actually these people, huge numbers also, then how is possible to accommodate all the 10,000 people inside the company? All the people say, I am the owner, I am the owner. You also can say that if you purchase a chair, you can say you are the owner. So if I purchase the chairs from the garbage person, I am going to say I'm also one of the owner. So in this such a way, all the 10,000 people, they actually want to enter into the company and they want to take the active participation in the business activity. Is possible? No. Is this possible? No, impossible to accommodate to all the 10,000 shareholders inside the company. You know, there's no space, no? So suppose if we allow to enter into the company and also they accept to participate in the company activities. So you can think about a decision making process. Is it easy to make a decision by uh, getting idea from all the 10,000 owners? It's impossible. No, we know that the decision making is very difficult because we can't take the decision simply by discussing with 5 or 6 people. Even, no? Then it's possible to take the idea from the 10,000 people. So that's what. So this public company point of view, what happened actually? These people, these the shareholders, in Karthik's story, all the 10,000 then the annual general meeting, each and every year, as per the Company Act, all the public companies, they have to conduct a meeting. That meeting is called as annual general meeting. After 12 months period, they have to call all the shareholders for the meeting. That is the annual general meeting, AGM. They will come to the annual general meeting. The annual general meeting, what they are going to do, they are going to elect a certain people, a group of people, to direct the company on behalf of themselves. Understand? The annual general meeting, the meeting is all these 10,000 shareholders, they elect a certain number of people in Sri Lanka. Actually, it's not a legal requirement for the number of directors. Actually, they are they elect a particular group of people, number of people as a group of people to direct the company, operate the company, supervise a company on behalf of themselves. That group of people is called as board of directors. I hope you heard about the term board of directors. So the public companies are operated or directed by the board of directors instead of these owners, who means the shareholders. So the annual general meeting, they elect the particular people. So then these particular people come enter into the particular company, the story Congress PLC. So 5 or 6 or 7 or 8 or 9 or 10 members are there, male and females are there. Those people are called as board of directors. So these people actually going to make all the decision of the particular public company. So, but actually they are the employees. The company pay the money to these board of directors, huge amount of money they receive as a salary. So, but they are going to make the decision of the company on behalf of the board of shareholders. So then here you can see this public company, this problem is there, the ownership and management. Ownership is actually held by these ordinary shareholders. These owners are sitting outside the company, but in the management, this particular company is managed by the board of directors. Managing by the different people, owners are different people. The owners are sitting outside. Only one time they will come to the company. During the annual general meeting, only they come to the company. Other 363 days, these board of directors supervise the company, operate the company, make a lot of decisions on behalf of these shareholders. So then what happened? The shareholders who were the owners, okay, needed a report from an independent expert on the accounts of the company managed by the board of directors who were the employees. This is a problem. Because actually what the things going to happen. So these are the board of directors are the elected body by the shareholders, and actually these board of directors receive a salary of the company, so they are the employees of the company, but actually owners are the shareholders sitting outside. So after 12 months, these the elected body, this board of directors, had to submit an account to these shareholders, owners. But the problem is these people never, the owners or shareholders never believe these employees or board of directors, because these people prepare the financial statement. These owners not easily believe the figures which is shown by these board of directors, because they prepare the financial statement, they prepare the statement of profit or loss, they calculate this is the amount of profit, this is the amount of assets and liability, this is a cash flow amount, or negative or positive, whatever it is, they prepared. So then finally they submit the document to the stakeholders, shareholders, owners, but these people, these shareholders, owners, never easily accept this financial statement which prepared by this board of directors. So that's what they need a report. If report means actually the owners or shareholders expect the report. Report means audit report. That's a key point. They need audit report from an independent expert, from the auditor, independent person, from accounts of the company, managed by board of directors, who were the employees there, because they are employees, no? Because the employee they are receive the salary. Whenever these people believe they are prepare their financial statements, that's what they, in order to make sure the prepared financial statement are correct or not, so they need a audit report. Then the objective of audit shifted means the move or change from shifted, and the audit was expected to ascertain whether the accounts were true and fair rather than detection of errors and fraud. You know that those days before industrial revolution, the the objectives of audit was to find out errors and fraud, to detect errors and to detect and prevent errors and fraud. But then after industrial revolution, these public companies emerged. Then the particular issue was there. There's a ownership and management problem between the stakeholders and the board of directors. So then the audit objectives was changed as true and fair. Please keep in your mind. It's very important exam point of view. So the objective of audit shifted more, and audit was expected to ascertain whether the accounts were true and fair rather than detection of errors and fraud. So here there's the origin. So then this slide indicates accounting and auditing. This is also another important one. So here we are going to discuss about what is the meaning of accounting, what's the meaning of auditing. So what's the connection between these two? Another is the connection between these is auditing and accounting. So accounting. So when you define the accounting, you can say accounting is the process of identifying, assembling, recording, classifying whatever it is. You know already you studied. The preparation and presentation of financial statements in accordance with accounting standards and where appropriate in compliance with the statutory requirements rest with the management of an entity, including board of directors. This is important here. I hope you know the meaning of accounting. The the thing you should know, the preparation and presentation of financial statement actually they're prepared by the management of an entity, management of the firm. Management means including board of directors. I hope you understand. No? When you see the sometimes the exact point of view, examiners of actions won't prepare the financial statement because you can say the management of the company. Management include the board of directors. So then when we say the auditing is important, auditing is an examination of financial statement. Examination is the verification or ascertain of financial statement. You know the financial statement with the P&L account balance sheet, as per statement, statements, equity, prepared and presented by the management of the entity. This is a connection between accounting and audit. Accounting, these are the accounting. Then the accountant prepare it means the management prepare the financial statements as per the accounting rules or regulation that is called as a generally accepted accounting principles. The auditing is an examination or verification of financial statement which was prepared and presented by the management. So that then one question. So which one happened first? The account. The first accounting start. Then the beginning the accounting start. The accountant stop the process. Then audit process. So that's what the people say. The auditing is the post-mortem activities. You know, auditing is a post-mortem because after prepare the financial statement, auditors are going to check or examine whether those records are correct or not. So that's what some people say is the auditing is post-mortem activity. I hope you understand. So sometimes the examiners of actions is a connection between accounting and auditing. Really explain the connection between accounting and auditing. The accounting auditing are connected with each other. So then we should be able to explain, yeah, this accounting. So then is auditing. This way this both connected. So then we can see the definition of auditing. So the lengthy number of sentences are there. So no bother about this one because never examiners or questions define the term auditing, define the term auditing and so on. So examiner never ask the questions. So sometimes the examiner gives this a definition, then the person asks the questions, um, explain these highlighted terms or key terms. So that's what I am doing again and again. Don't try to memorize, try to understand properly. So the definition of auditing said is auditing is defined as a process carried out by an appointed qualified person or body whereby the records and financial statements of an entity are subjected to independent examination, okay, in such detail as will enable the auditor form an opinion as to their truth and fairness of the financial statement. This is a definition of auditing. The definition is not a method, but you should clearly understand the key terms used in this definition. So the auditing is defined as a process carried out by an appointed qualified person. So one key term is qualified person or body. Maybe the person is a qualified individual person or the particular body mean the particular firm, right? Audit firm. Whereby the records and financial statement. The auditor is going to take the records, different records, and financial statement, P&L account, the balance sheet, cash flow statement, statement of equity, all the documents on random basis of an entity are subjected to independent examination. That's the important. When we say when we define the audit, the term is very important. That's a particular examination, it's a particular checking process, a particular investigation should be independent. We will discuss the meaning of each and every term deeply in such detail as will enable the auditor, with the auditor, form an opinion. This is another one, opinion, as to their truth and fairness of the financial statement, true and fair of the financial statement. So here you will see one by one. This is very important in the exam point of view. No, don't try to memorize, understand. What's the meaning of each and every key terms. Here, now when we say the independent examinations, this key term says it means the conduct of audit should be carried out independent of the person who provided the records and financial statement. Actually, you know that when the auditor do the audit process, the particular company employees definitely the support of the auditor. They provide the required document. The auditor every time asks a different document. For example, the auditor asks bring the debtors record, creditors record, suppliers records, fixed asset register, inventory register. So then the bank records statement. So anytime auditor after documents from the other company employees, they normally provide the document, but they can support the auditor, but never they disturb the auditor. That is that particular examination, the auditor work should be independent. It means the conduct of the audit should be carried out independent of the person who provided the records and statement. Claim company employees, they provide the document, but they can't disturb or interfere in the auditor process. The work of the auditor should not, under any circumstances or situation, be influenced by the claim. Claim can't interfere in the audit process. So that's an independent examination of the audit process should be independent. Okay, I hope you understand. No? Yes. Second key term, suitably qualified person. The previous video lecture also I clearly explained that person, the auditor should be expertise person, the qualified person. So it means the auditor should be the professionally qualified. Professionally qualified means we'll discuss clearly in the handout number 3, the company. This company X says person, what are the qualifications to be there. So if you want to become auditor, what kind of qualifications you should have. So in Sri Lanka, the person who wants to become an auditor, the person must complete CS Sri Lanka. In addition, they have to have some years of experience, some other skills. The mandatory one, the person should complete chartered accountants. So the suitably qualified person, it means the auditor should be professionally qualified, have completed the approved professional accountancy examination, and have the relevant skills and experience and integrity to carry out the examination. That is indicated by suitably qualified person. I hope you understand. Third one is their records and finance statement. You know, the normally when the auditor uh, come to the company, then the person start to check the document. Other documents are uh, checked by the auditors, all the records and finance statement. Don't think that only the auditor check the finance statement. In addition to finance statement, the auditor check all the records, but on random basis. So the records are source documents, everything percentage. So definitely the company, the client company provide all the document which are requested by the auditor. So the include written authorization to effect the transaction, source document, books of payment, everything as for everything um, checked by the auditor. That is a records and financial statement. It's important one. Don't think that auditor only check the financial statement. That's a main one. In addition, auditor asks different documents from the client, company, employees. Then is important one is opinion. Here important one. Auditor finally give the opinion. You should understand what's the mean. Opinion is not the exact results. Please clearly understand. When you say the opinion, it should be the auditor's comment, not the exact or actual results. Actually, the 100% correct. No, opinion. When you say the opinion, it cannot be 100% correct. Maybe 90 or 95%. So because that's the you say the auditor finally give the opinion or conclusion. That may be the comment, the opinion of the person, not the exact or actual person. So here it is an expression of the auditor's provisional viewpoint. What does the meaning of expression of the auditor's provisional viewpoint? Means when the auditor check the documents, the person gives feel the feeling of the person judgment. Okay, viewpoint about the financial statements after exercising his or her judgment. So check the document, then we see the auditor judge about because compare something, then yeah, as per all the accounting standards are properly complied, or then everything is okay. And then person with the positive opinion. So then when you say the opinion, it is the expression of the auditors, the provisional viewpoint. That's important. The person, the viewpoint should be the provisional viewpoint about the financial statements after exercising. So the judgment about skills and based on the evidence level. Because the person character of evidence, based on the evidence, check the documents. In addition, person the auditor use his or her knowledge or skills, experience. Finally, the person come to the conclusion or opinion based on the provisional as a provisional viewpoint. So the person is a professional person, CA qualified. So the person always think the view the professionally the person should think. That's an important one, no? Yes. Then finally, that the opinion should be the true and fairness of the information. What's the mean true and fair? So true and fair means the opinion says the true and fair. It means the financial statements are free from material mistake. This is very important. So I know, you already heard about the term material. So that material is different. But at the audit point of view, the material means materiality. It doesn't mean materiality. So it's a very interesting one, very important one in audit. So the materiality means, so that, for example, simple example I can explain. So that you can, the two friends are there. The 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 the, the first friend name is A, other one is a B. A actually the father, A father is a farmer. The other person B father is a lecturer. Or you can assume doctor or engineer. But A father is farmer. B his father is a doctor or engineer or lawyer or lecturer. So the story is, the particular day, the person A the misplaced or rupees 1,000 rupees. The person misplaced the rupees 1,000, put somewhere. So that the thing is that this person also misplaced or miss rupees 1,000. That person B, his father is a doctor or engineer or accountant or lecturer, but person A father is a farmer. Actually, he missed rupees 1,000. My question is, the the both people, the feeling is same or not? He both people miss rupees 1,000. He also miss rupees 1,000. B also miss rupees 1,000. A also miss rupees 1,000. B also miss rupees 1,000. My question is about both of them. They are both people. The person feeling is same or different? Definitely it's different, because his family situation is something critical situation. Yes, his father is a farmer, so income is a very limited one. So the rupees 1,000 is a big amount to this person A. But B, his family background is something different. The rich person, because they are his father is a accountant, so the engineer, or a doctor or lecturer. So compare with A, he is a very rich person. So rupees 1,000 will not be matched to this person B and compare with A. So that's the thing is the A point of view that rupees 1,000 is a material. Material means very important, serious concern. This view, but this another B view is not a matter. It's okay, 1,000 because that's okay. Miss the 1,000, so not a matter. So that is a materiality. So the audit also here, it means the financial statements are, when you say the true and fair, let's say the financial statement are free from material mistake. Free from material mistake. It doesn't mean 100% correct. Please understand. So that's the things you should understand when you study audit. So when the auditor check the document, the finance, especially the financial statement of a particular company, so it doesn't mean the it 100% should be correct. Some mistakes may be there. So for example, is the Google company. Google is a Google Incorporation is a very popular company worldwide. So the Ernst and Young is the auditor of the Google Incorporation. So then, so suppose 20,000 mistake happen in the Google company financial statement for the last year. So when the Ernst and Young, the audit company, they found actually the 20,000 amount is wrongly they entered. So what happened? Then you can say, oh, an auditor, because in 50 cents or even 1 rupee, they definitely they say, yes, no, don't think so, because that is the materiality say, from the Google point of view, compare with their annual income, annual turnover. So 20,000 is not a matter. 20,000 is not a material one. It's not a material one. It's immaterial to the Google. But another grocery shop, you can think about your area. From the grocery shop, suppose they have the audit, the 20,000 mistake happened, that should be the very serious one. That is grocery shop point of view. That's a material. Yeah. It means the financial statements are free from material mistake. That's a free from material mistake. There's no big mistake. There's no big mistake. There's no fraud. another way you can say. So the proper books of accounts have been kept. The company, the particular firm, they properly keep all the record and accounts. Then the financial statements are consistent with the underlying records. Company, they keep the records are very consistently. Actually, they didn't oftenly change their accounting policy. So the finance statement have been prepared in accordance with the accounting standard. They properly adopted all the accounting standards. And relevant rules they properly follow the company act. As I said, everything is fantastic. It means free from material mistake. There is no big misstatement. There's no big mistake. So that indicated by the drawing here. I hope you understood the things. So when you define the term audit, so the exam point of view, the examiners of actions define the term audit or define and discuss. The examiner may give the definition. So then the examiner may ask of actions discuss or describe the key terms underlying in the particular definition. Then we should be able to clearly, deeply explain the key term. Don't think that is definitely you should write all these 5 sentences. Just we expect that that's a meaning of that one. In different examination, just we expect that means that the audit should be carried out or independent of the person. So otherwise you can say you can write in your own way. So that indicates that during the audit process, the employee of the company cannot interfere in the auditor work. That's all. The way you understand, you can write. So just we take the concept. Don't we expect the lengthy paragraph. So then the suitably qualified person, you can say the person should be the professionally qualified. So, the records and statements, you can say all the records they have to go. You can mention all the records. Opinion. So it's an expression of this profession. So that's that one. This I hope you understand. This is given another definition. Actually, this definition is given by American Accounting Association. This says define auditing as auditing is a systematic process of objectively obtaining and evaluating evidence regarding assertions about economic actions and events. That means the activities of the company and the transactions to ascertain the degree of correspondence between those assertions, the established criteria, and communicating the results to interested users. This is a definition given by Rebele, American Accounting Association. We don't know what is definition. So then we can see the objectives of auditing. So here, when we say the objectives or aims or purpose of auditing, we should know what are the objectives or what is objectives or what is aim, what are the aims or what are the purposes of auditing. So here I have classified into primary and secondary objective, secondary incidental objective. But you can think because the different textbooks say the different way of interpreting these objectives. It means you can't see the same way the primary and secondary objectives because textbook to textbook may be different. So, but the thing is, you should understand these are the objectives for auditing. By I put this way, such a way the primary objective and secondary objective, then I feel you can easily understand that this is a primary or secondary. Then don't think that all the books have say this way, the objective auditing is a primary, the secondary. First, refer the textbooks. Textbooks simply say in the one sentence, this is objective audit. So don't take that as issues, no? But try to understand. So when you say the primary or main objective, to help an auditor to form an opinion as to whether the books of accounts and financial statements show true and fair view. That's a main objective, the main purpose or main aim of auditing to support the auditor to form an opinion whether the financial statements show true and fair view of the business. That's a primary one. Suppose there's a secondary objective of audit, you can say in order to achieve that the primary objectives, these are the incidental objectives such as to detect errors and fraud, detect me to find out errors and fraud, to prevent me to prohibit, to stop errors and fraud. Third one is also important. So that to help the client to improve upon his accounting and internal control system. That one says, actually, don't think that auditor duty only to provide opinion. So after providing the opinion, the particular auditor can give some suggestion or recommendation to the particular client company for their future improvement, future adaptation. So because suppose there's any problem in the internal control system, so that's a objective audit to give some suggestion or tips or recommendation to the particular client company or company to overcome those problems. So that also another objectives of auditing. So then the slides I explained the objectives of auditing and the primary and secondary objectives are there. Then yes, this is another importance of fraud and error. This is very important. Fraud versus error. So when we study audit, we have to have a clear understanding about fraud and error. So the first we can understand what's the meaning of error and what's the meaning of fraud, and then we can get to know the examples are there. So when we say the error, I hope you are very familiar because we also make some mistakes, no? So day-to-day life, we may make a lot of mistakes. So that's a human errors, no? That's a human. Everybody makes a mistake. That's a nature, no? So that kind of things are called as error. It means error refers to unintentional mistakes. Please underline the mistake, unintentional mistake, not an intentional, unintentional. Without knowing me, we do something. So that person, he or she don't know the particular matter. That is called as unintentional mistakes in financial statement. But fraud, this is the purposely one. Purposely do something. So that here the fraud refers to the use of deception or dishonesty. It means cheating. It's a very easily to understand cheating others. That is definitely the fraud here. The fraud refers to the use of deception or dishonesty. Why? To obtain an unjust or illegal financial advantage. So company this normally happen, no? It's a very, very important one because the thing is that some people, employees of the company, they plan to um, earn some illegal financial advantage. So then definitely that will come into the fraud. So because in the University of Japan also before 2 3 years, a particular person in the finance branch interdicted due to this fraudulent activities. So because you also know some example in the private organizations, a lot of issues happen in the commercial bank. So in the case, you can understand. I want to tell you all. This is not good to say, but even I want to tell you that before 10 years, I think yes. So before 10 years, our graduate, university graduate, he's very clever person. He wasn't working commercial bank. Um, the, after joining commercial bank, after 5 to 6 years, he took some money from the domain account. No? I know you know the what's meaning the domain account in the bank. Domain means the account is not active for the longer period because sometimes the source particular owner of the particular account maybe in the abroad. So that the particular person, bank staff, what he did, took the money by using some illegal documents. So took the money and sent off those money to his girlfriend, huge amount of money. So this happened before sometimes. Then because the domain account, after sometimes a particular person come to the bank and discuss about his accounts in the particular commercial bank. Then bank manager try to search the particular account, the balance, a balance is the balance was nil. So then That's a confused because the particular customer very confident because particular amount was there in the account. And manager also the domain is a withdrawal happened because person is in abroad. Person was in abroad. So then how the who and withdrew money, that kind of action, lot of issues happen. Finally, they found the person, then interact from the bank. It's a story that is nice to tell you all, but then only you can understand clearly. This is an example of the fraud. There's a deception or dishonesty or cheating that others to get some kind of benefits. This normally happens. So the advantage is intentional. That should be the intentional. This is when we say the errors, that is an unintentional mistakes. This is intentional. The use of deception or cheating others. Then when we see the examples, so then the exam point of view, the examiner may ask questions, compare and contrast errors and fraud and give examples. Define and discuss the errors and fraud. So the kind of question should expect for your examples. So when you see the errors, the good example is a mathematical or clerical. That's a human mistake. Naturally we make some mistake by mistake. So mathematical mean when the management, the accountant prepare the financial statement, the person at 2000 plus 200 is equal 2400. So the mathematical mistake, arithmetical mistake, so the clerical mistake. So second example, oversight or misinterpretation of accounting policy. So when the particular firm, when they prepare the financial statement, so when they apply the accounting policies, they oversight to misinterpret the policies without knowing them, it became. So that is a errors. Is unintentional. So third one is an unintentional misapplication of accounting policies. When they misapply the accounting policies unintentionally, that is errors. But intentionally, when they misapply the accounting policies, that is fraud. When when the people do intentionally, that is fraud. When they do unintentionally, it is errors. So some of the examples of fraud, you can see the manipulation or the falsification or alteration of records and documents. So this normally happen. No? They will make some alteration in the figures or in the records. That's a fraud. That's a cheating. Then the misappropriation of assets or debt. Debt is very famous. No? That is also fraud. Example for fraud. Then is a suppression or omission of the effect of transaction from records or documents. So sometimes the omit some transaction, important transaction from the records. It means omit means they fail to record a particular transaction. That's an omission. That's also one of the fraud. Then is a recording of transaction without substance. This is another one. Amount is there. They place the amount, but when they check the auditor, check the base document or source document, no substance. Without evidence, the accountant recorded particular figures. The amount is transferred, but no source document, no substance, no evidence. Then is how the auditor accept this one. There's a fraud. Something happened. That should be verified, clarified. So this is a fraud and errors. I hope you can understand clearly what's the meaning of errors, what's the meaning of fraud, what are the example for errors and fraud. Yes, okay students, today I'm going to finish my video lecture, part 2. So what we discussed in the today lecture, so I'm going to recap things. Today I started my lecture from this one. Introduction, overview of auditing. Here we discuss some the story, the points format. So then finally I stress that is in order to get a reliable information, definitely the decision makers need so the sort of some sort of verification, that is audit. So then we discuss the origin of audit, the history. So we will discuss the things. We discuss the Early objective of audit was to detect and prevent errors and fraud. Then, after some times after industrial revolution, it was changed as true and fair. In the between the two, we discuss about problem with ownership and management in the public companies. That's the reason. Then the audit objective was changed. So then we discuss this accounting and auditing. So then we discuss the definition of auditing. That is very important. Exam point also a point also that is very important. You should take some concern about this definition. It means that you should clearly understand each and every concept or key terms in that particular definition. That's the meaning of independent examinations. That's the meaning of suitably qualified person. What is mean by records and financial statements? What is mean by meaning and what's the meaning of so then we discuss about this objectives of auditing. The primary objectives was there and secondary objectives also there. The then we discuss about fraud and errors. What is the meaning of fraud and errors? Some examples also we discuss. So I'm going to finish my video lecture. So this should be the part 2. I will upload this video. Please make sure you watch all the videos and also you read the materials properly, because the topic you may expect your first as an exam end of the week. No? Okay, students. Goodbye.